How does the procure-to-pay process work? This is day 7. Let us waste no time. So, yesterday we spoke to the customer journey, if you will. Okay, we spoke to how customers go from an agreement with the company to ultimately paying the company. Okay, now today we're going to focus on the supplier side. We're going to focus on essentially how a company goes from needing some kind of resource to use within its productive process, to ultimately acquiring and paying for that resource, how they're going to account for it, what's the general process for it, all that good stuff. Okay, so yesterday we established the fact that all companies leverage their operations to essentially deliver on the promise that was put forth within the agreement between the customer and the company. Now, operations don't operate in isolation. This function needs resources in order to function properly, okay? And that's where procurement comes in. Today, we're going to focus on how a business acquires what it needs and eventually pays for it, okay? Now, we know by now that all companies are transformation systems. They take economic resources and via their productive processes, they transform them into valued outputs. But in order for this transformation process to occur, we need resources in the first place, okay? And that's what procurement is all about. Procurement is about acquiring the resources that we're ultimately going to use within our productive process. So the order to cash process that we covered yesterday is primarily about cash inflows. We're serving our customer, we're billing this customer, and ultimately collecting on this customer account. Now, procure to pay is about cash outflows, meaning we're going to identify a vendor or supplier that we want to work with. We're going to ultimately work with them. They're going to bill us, and that's going to result in a cash outflow. Okay. So this process always begins with a need. The company needs some kind of resource, some kind of service, some kind of something. Okay. The company has some kind of lack, and it can't satisfy this lack internally, so it has to go to an external party. That's generally how it goes. So after the company identifies that it needs something, obviously this is going to be the catalyst. It's going to purchase whatever it needs, be it some kind of equipment, some kind of raw material, some kind of service, whatever it happens to be. Obviously, once they purchase it, they're going to receive it, and then they're going to be invoiced by the supplier or vendor. Now, if the company did not pay up front for this, if the company didn't pay cash for this in full, that's going to result in what we call accounts payable, which is a liability account. Obviously, they're going to pay for this if the company is of high integrity, and that's pretty much how it goes from need to payment. This is the general flow of any procure-to-pay process. So stage one, something inside of the business requires resources, okay? We need raw materials. We need some kind of software or service, or we need something for our equipment, okay? Or we need equipment itself. The company then arranges to acquire it via a purchase order, a contract, a subscription, or a corporate card. The supplier communicates what's owed via the supplier invoice, okay? And up to this point, we've received a resource. We have received whatever service or good we happen to acquire from this vendor or supplier, but we have not paid this individual or this entity. We have not paid this organization. So since we owe the supplier money, that's going to give rise to a liability account called accounts payable. Okay, this is found on the balance sheet, and it is a current liability. Now, once we settle this obligation, once we pay for it in its entirety, that's going to result in a cash outflow, and that's the end of the story, okay? Now, I want to contrast accounts payable with what we spoke to yesterday within the order to cash process, more specifically to when we spoke to accounts receivable, okay? So accounts receivable occurs when a customer owes us money. This is essentially a future cash inflow. Now, accounts payable occurs when we owe a vendor or supplier money, and this is a future cash outflow. That's why accounts receivable is an asset, and that's why accounts payable is a liability, okay? Now, let us end with how I typically end things. How does your company buy something? What's your procure-to-pay process look like? What creates the need, and who requests the purchase? How is the supplier selected, and how is the order placed? When does accounts payable arise, if at any point in time, and how does the supplier get paid? And more specifically, let's put our process engineer hat on. Where could this process break? And which economic driver within your company would it hit? If you like this kind of stuff, definitely consider subscribing, like, comment if you have questions, and stay tuned. Thank you.